What's up, everyone? So today we are going to be talking about what is hands down the single most tax advantaged account in the world. Hi, my name is Ben, and this channel is dedicated to all things personal finance, helping you earn more, spend less, and invest the difference. So let's get started. Now, we all know that various types of accounts, like a traditional IRA or a Roth IRA, have different tax benefits to them. And because of these tax benefits, the money in these accounts is able to grow and compound at a much faster rate than any other type of account. And there's 3 different times in your investing life cycle that your money can be taxed. It can initially be taxed when you first earn it at your job. And then while your money is in this account and it's growing, paying dividends and things like that, it can be taxed again. And then finally, when you go and sell those assets and use that money for whatever it is that you plan on using it for, the gains on that can be taxed as well. So there's 3 different times that your money can be taxed. Now, a traditional IRA or a Roth IRA are going to eliminate 2 of the 3 times that this money can be taxed. So it's pretty good, don't get me wrong. But there's one account out there that is going to eliminate all 3 of those times, completely and utterly tax-free. And this is going to allow your money to grow at a significantly faster rate, which is going to leave you with more money in the long run. Yep, that's right, we're talking about an HSA, otherwise known as a health savings account. And just like a retirement account, like an IRA, is used to save for retirement, a health savings account is used to save for, you guessed it, your health. Now, I know the feeling. Some people are thinking in the back of their minds, like, I don't have any health expenses. Like, I don't need a health savings account. And that's great. Right now you might be young and invincible, but at some point age is going to catch up to all of us and our bodies are going to start falling apart. So at some point in our lives, we're going to experience some medical problems. And so it's important to start saving now so that when the time comes that we actually have enough money available to pay for that kind of stuff. In fact, one of the highest causes of items like bankruptcy and homelessness is all due to various health problems that come up that people can't pay for. So it's very important that we start saving for this stuff as quickly as we can so that we are properly prepared when the time comes. So just like all types of specialized accounts, there is an annual contribution limit to what you can put into your HSA account. So for 2020, that amount is going to be $3,500 per year if you're single, or $7,100 if you got a family. And this number is also going to increase by an extra $1,000 if you are over the age of 55. Now, once you put money into this specialized HSA account, you can use that money to buy pretty much whatever types of investments you want. So if you want to buy stocks or bonds or mutual funds, index funds, you name it, you can buy that inside of this specialized investing account, and then that money will continue to grow and compound at a very rapid rate because it is completely tax-free. Now, if an HSA account did have a downside, it would be that not everybody qualifies for a health savings account. You see, only people that have a specific type of insurance qualify for this program. Your insurance needs to be what is known as an HDHP, a high deductible health plan, in order to qualify. But before you start freaking out at the words high deductible, a high deductible health plan does not mean a crappy health plan. While the deductible for these types of insurance plans are obviously higher, as the name implies, they are not astronomically high. Generally speaking, if you're a single person and your deductible is right around $1,350 or more per year, chances are your program, your insurance plan, qualifies as a high deductible plan. Or if you got a family, this number typically hovers right around $2,700 a year for your deductible. Now, the good news is, even though your deductible for these plans is a little bit higher than your traditional insurance plan is, the premiums, the monthly premiums for these plans are typically significantly less. And this can be nice if you are one of those people that is still young and invincible. You know, the chances are in any particular year, you are very unlikely to need to seek medical care. So you can save money each and every month by paying a lower monthly premium and getting one of these high deductible plans, and then taking that difference, in your monthly premiums and setting that money aside into a specialized account like an HSA, so that when the time comes, when you get a little bit older and you do have medical problems, you already have plenty of money in your health account to be able to properly pay for all of these medical expenses. So unlike a flexible spending account, this money in an HSA does not just suddenly vanish at the end of the year if you don't use it. This money will continue to grow and compound forever, or until you actually need it for a medical emergency. And thankfully, a lot of HSA providers make it super easy to actually pay for your medical expenses. A lot of them will even give you a debit card that you can just swipe at your doctor's office, or they'll provide you with special checks that you can be used. The only thing is you got to make sure to keep your receipts, because you are going to need to document any withdrawals out of your HSA account. So then the big question that typically gets asked is, well, what qualifies as a medical expense for these HSA programs? Because a lot of times the government will have a great idea like, hey, let's help people save for medical costs. And then they bog it down with red tape or extra rules and laws and problems that just make it unusable. But thankfully, an HSA is super easy. Almost anything that you can possibly think of as far as medical treatment is going to be covered under an HSA. So obviously, the list of items that are going to be covered under these programs is going to be massive. But a quick, short list, just to kind of give you an overall idea of what could be covered, is going to be things like prescription medications, birth control pills, dental issues, surgery, acupuncture, physical therapy, guide dogs. Most anything that falls under any kind of a treatment plan is going to be covered. About the only thing that's not going to be covered are things that are not treatment related, but are more considered just to be overall just generally healthy for you. And these could be things like buying organic foods, vitamins, gym memberships. Things of that sort are not going to be covered. Additionally, thanks to the Affordable Care Act, a lot of your routine maintenance items are also going to be covered. So things like your normal routine checkups, flu shots, some lab tests, a mammogram or colonoscopy. These type of items are going to be covered and do not count towards your out-of-pocket expenses under these high deductible health plans. Now, if you start investing in one of these HSA accounts, then over the years, theoretically, this money could grow to a fairly significant number because it is growing completely tax-free. Now, as you get older, obviously the chances of you needing this money increases due to your body starting to deteriorate and fail. But what happens if you get lucky and you don't have any medical problems and now you just have this large amount of money sitting in a medical account? Well, in a situation like this, once you turn age 65, you can begin withdrawing money out of that account for items other than medical expenses. And it's treated just like a traditional IRA is. So you do get taxed on the withdrawal, but the initial deposit and the growth while it was in there, those are going to be tax-free in the exact same way that a traditional IRA is taxed. So as far as taxes is concerned, in a worst case scenario, it's just as good as your traditional IRA. But in a best case scenario, it is drastically better than every other account out there. And a fantastic benefit of an HSA account, and one that I don't think is talked about nearly enough, is the fact that you don't need to file a claim for your medical expenses right away. As long as you keep track and keep your receipt, you can file a claim against your HSA account decades down the road after the medical event actually happened. But you're saying, why would you want to do that? You have an account specifically designed to pay for medical expenses. Why would you not want to actually use that account when you do have a medical expense, right? And the reason why you might not want to file a claim immediately is because the money in this account, since it's completely tax-free, is growing faster than money in any other type of account. So theoretically, you want to leave the money in this account for as long as humanly possible so that it will continue to grow at a much faster rate than all of your other money is growing at. So let's take a hypothetical example. Let's say you have a medical emergency and it costs $1,000. Now, if you don't have a better way to pay for it, then yes, obviously take the money, take it out of your HSA account, file your claim immediately, because that's what this money is there for, right? It's to pay for medical stuff. But let's take a slightly different scenario and let's assume that you do have a little bit of money just sitting around in a checking or savings account. You know, maybe you have a little nest egg sitting there, or maybe you just got your taxes, your refund back or something like that. So you actually have $1,000 sitting in your checking account that you could potentially use that money to pay for your medical expenses instead of money out of your HSA account. So in a situation like this, as long as you keep that receipt, you can pay for your expenses out of your checking account and continue to leave the money in your HSA and allow that to grow completely tax-free, which will ultimately lead you to having more money overall. And then at any point in the future, this could theoretically be decades down the road, if at a later point you need that $1,000 for whatever the case may be, you can then file your claim and your HSA will at that point take that $1,000 out, and then you can use that to pay for your credit card bills or whatever it is that you've got going on. So you can file a claim years down the road, which could, like I said, allow your money to grow at a much faster rate by leaving it in your HSA account for as long as possible. And the last thing I'll say about an HSA account is, just like a retirement account, if you try to access your money before retirement, you know, you get penalized and there's taxes and that kind of stuff associated with withdrawing money early. Well, the same thing applies to your HSA account. Not only are you going to pay taxes when you withdraw it, but you're also going to incur a massive 20% penalty on the money that you withdraw. So you want to make sure before you start contributing that you're not going to need this money for anything else, because once it's in there, unless you're going to use it for a medical expense, you pretty much need to leave it in there, because you do not want to be paying these taxes and penalties associated with it. So that's going to do it for us today, folks. Why the HSA account is hands down the best account type out there. It has tax benefits that are unrivaled by any other account type. So if you do qualify for an HSA account, I highly suggest you start tucking away money immediately. That way, when you do start having medical expenses, you're properly prepared for it. And if you did like this video, please be sure to subscribe, leave a comment down below, and I'll see you all again next time. Thanks.